Welcome to the deep dive. We talk a lot about the path to buying a home here in the U.S., but what if you're financially stable, you're working, you're paying your taxes, but you just aren't eligible for a Social Security number?
Right. That gap, it creates this huge financial roadblock. And that is exactly why the ITIN mortgage market even exists. It's a very specialized route for a specific group of people that, conventional lenders just can't really serve.
Okay, so let's really unpack this corner of the lending world. We're talking about people who are filing taxes, working, saving,
Yeah.
but because they don't have that SSN, they're immediately locked out of Fannie Mae, Freddie Mac, FHA, all the standard stuff. So our mission today is to cut through all that complexity. We're going to explore what these ITN loans are, why they're so essential, and how the qualification process is tailored to measure stability without the usual paperwork.
And let's start with the absolute basics for you listening. ITIN. It stands for Individual Taxpayer Identification Number. It's a 9-digit number, and it's issued directly by the IRS.
Not some third party, the IRS itself.
Exactly. And it's specifically for people who have to file federal tax returns but who can't get a Social Security number, maybe because of their immigration status.
And we really have to stress this is a fully legitimate ID from a core federal agency. It's not a workaround. This is their official key to the U.S. tax system.
Absolutely. And here's a little trick, a way to remember its specific function. All ITNs, and I mean only ITNs, start with the number 9.
Oh, that's interesting.
Yeah, that number 9 is like a signature. It shows what it's for. And it's required for non-citizens, for immigrants living and working here because, look, at the end of the day, if you earn income in the U.S., you have tax responsibilities.
So that leads to the big question. If they have a legitimate number from the IRS and they can prove they're paying taxes, why can't they get a conventional loan? Why are ITN loans almost always in this specialized, non-qualified mortgage space, or non-QM as it's called?
And that's where you run right into the regulatory wall. It's all about lender risk. The main barrier usually isn't financial. It's about the uncertainty of their legal status. The ITN confirms they're paying taxes, sure, but many ITN holders might not have, say, a legal entry status or a valid long-term work visa that those government-backed programs demand.
So the lender's fear isn't, will this person pay their mortgage?
No.
It's more like, will this person be able to stay in the country long enough to finish paying the mortgage?
Exactly right. That's the core of it. Conventional guidelines for conforming loans are just. They're rigid. They require proof of legal residency and a valid work permit. And since many ITN holders don't meet those specific immigration standards, the lender just sees them as a higher risk. If the borrower could potentially be deported, the lender is facing an immediate default.
And a very messy recovery process, I mean.
Very difficult one.
Okay, that makes sense from a risk perspective. But what does that mean in the real world for the borrower? Because the loan is non-conforming, it's not government-backed.
Correct. And since they aren't government-backed, lenders can't just sell these ITN loans on the secondary market like they normally would. They have to keep them on their own books. It's a process called portfolio lending. And if you're going to carry that risk yourself, well, you need a higher rate of return to justify it. So the consequence, the bottom line, is that ITN loans almost always have higher interest rates. And they usually demand much bigger down payments than a conventional loan. It's basically a risk premium.
Okay, let's shift gears to how they actually qualify. If the SSN-based credit system isn't always there for them, what kind of documentation gymnastics do they have to go through to prove they're a good bet?
Well, it's a completely different mindset. Instead of just relying on a FICO score and an SSN, lenders are focused on proving two things: consistent work and consistent tax payments. They'll almost always require proof of 2 years of continuous employment and 2 years of filed tax returns.
So they're building the picture piece by piece.
Exactly. They'll look at everything: utility bills, bank statements, you name it.
And what about FICO scores for those ITIN holders who have managed to build a credit history? What are we seeing there?
It's a spectrum, really, but the requirements are definitely tighter. For a lot of the, let's call them mid-range programs from lenders like Community Savings or Sunrise Banks, you're seeing minimum FICO scores starting around 660, maybe 670. Those are the more conservative options.
But I remember from our research, there were programs that were a lot more flexible than that. Ones aimed at people who are really kind of outside the traditional financial system.
That's a critical point, yeah. While 660, 670 is common, some programs go much lower. We've seen options that start as low as 580, maybe 620.
Wow.
But when a lender accepts a score that low in a high-risk category like non-QM, there's always a trade-off, a big one.
So what does that trade-off look like? Are we talking about sky-high rates or just a massive down payment?
It's both, but the down payment is usually the main lever they pull. An average ITIN loan might need 10 to 20% down, but a program that accepts a 580 FICO score, they might demand 25, maybe even 30% down.
So they're essentially saying, we'll take the credit risk, but you have to put so much skin in the game that we're protected if you default.
That's it, exactly. You insulate us from the risk.
So even for someone with a good score, say 670, why is the down payment still so much higher? If they put 20% down, their loan-to-value is 80%. Why should their rate still be higher than a conventional loan? Aren't they proving they're reliable?
And that's the frustration for the borrower, right? But it all comes back to that fundamental risk we talked about, the regulatory risk, the secondary market risk. With a conforming loan, the government is basically saying, we've got your back. With a non-QM loan, the lender holds all of the risk, all of it. So they have to price the rate high enough to cover a potential default and the legal status uncertainty. A higher down payment helps, for sure, but it doesn't just erase the non-conforming nature of the loan. For example, a lender like First National Bank of America, they require a minimum of 15% down. That's their floor.
It sounds like that big down payment is just the entry ticket. It's the prerequisite to even get in the door. Are lenders flexible on how people come up with that money?
Thankfully, yes. This is where you see some real flexibility. For first-time homebuyers, some of these programs, like Sunrise Pathway to Home or FNBA, they explicitly allow gift funds for the down payment.
That's huge.
It is. They know that cash can often come from family. And critically, some programs even let the seller pay the closing costs, which, drastically cuts down the cash you need to bring to the table.
Okay, let's zoom in on income documentation. This is always a big one, especially for self-employed people. It's a common scenario for ITIN holders. You can't just hand over a W-2. So what does that alternative doc menu look like for proving your income?
The non-QM menu is incredibly varied. It has to be. Lenders know that tax returns for business owners can show low income because of write-offs, so they've created other paths. You can use a profit and loss statement, a P&L from a CPA. There are 1099-only programs, or, and this one is really popular, you can use bank statements.
Before we get to bank statements, you mentioned something called asset qualifier depletion. What in the world is that?
That's for borrowers with a lot of liquid cash. With asset depletion, the lender looks at your liquid asset savings, investments, and basically turns them into a monthly income figure. They'll assume you can draw down a certain amount each month over, say, 10 or 15 years.
So you might not need to show much traditional income at all as long as you have huge reserves.
Precisely. It's a sophisticated tool, for sure.
But for most self-employed borrowers, it's going to be the bank statement analysis. So walk us through that. How does a lender take 12 months of deposits and turn it into a number they can use?
It's meticulous work, and honestly, it's often a big shock for borrowers. The standard is 12 or 24 months of consecutive bank statements. If your business is seasonal, like construction or landscaping, they'll almost always demand 24 months to smooth out the highs and lows.
And the calculation is the real hurdle.
It is.
Okay, lay out the math for us.
So when a self-employed person uses their business account, the lender knows that's not pure profit. Those are gross deposits. So they have to apply what's called an expense factor to account for the cost of doing business. The standard baseline assumption is a 50% expense factor.
Wait, hold on. So if I'm a consultant and I deposit $10,000 in a month, the lender just assumes half of that, $5,000, was a business expense, and only the other $5,000 counts as my income.
Precisely. It's a huge haircut right off the top.
Yeah.
But, and this is the surprising part, those expense ratios can change dramatically depending on your line of work.
How so?
A CPA can attest to it, or the lender uses industry standards. For a high-cost business like retail, trucking, or construction, they have huge overhead, right? Inventory, materials. Some lenders assign a 90% expense ratio to them.
90%. So if a successful contractor, let's call him Marcos, if he shows $200,000 in annual deposits, the lender only counts $20,000 as his income.
Yep, $20,000.
Wow. That would absolutely crush his ability to qualify for a decent mortgage.
It does, and that's why the planning is so important. Now, compare Marcos's construction business to, say, a physical therapist, professional services, healthcare. Those businesses usually get the more favorable 50% expense ratio because they have higher profit margins, less overhead. Understanding that ratio before you even apply. That's the difference between qualifying for a $150,000 loan and a $300,000 loan. It's that dramatic.
So the CPA's role becomes incredibly important there. Okay, moving on from income, what about credit history? If you haven't used credit cards or traditional loans, how do you build that history?
They look for non-traditional credit trade lines. They just need proof you pay your bills consistently. The standard requirement is usually one trade line that's been paid on time for 24 months or two trade lines for 12 months, and they have to show recent activity.
What counts as an acceptable trade line? Is it my Netflix subscription?
Huh. No, they specifically reject things like Netflix or Spotify. They want to see things that show consistent, required monthly payments. So utility bills, electric, gas, cell phone bills, monthly car insurance payments, things you have to pay. And there's a really valuable one for renters. For first-time homebuyers, a good 12-month verification of rent history, or VOR, can often be used to meet the trade line requirement.
That's great. I mean, showing you pay your rent on time every month is a powerful sign of responsibility.
A very powerful one.
Okay, let's pivot a little. Let's look past buying the home and think about the long term. Why is that ITIN so important beyond just getting the mortgage in the first place?
This is such a critical piece of the puzzle, especially for anyone who might sell their property down the road. If the ITIN holder is considered a non-resident alien for tax purposes, that ITIN becomes essential for complying with a major federal law called FIRPTA.
For PRPT.
That's Foreign Investment in Real Property Tax Act.
That sounds like something you do not want to get wrong. What does it do?
FIRPTA basically requires that when a non-resident alien sells U.S. property, the buyer has to withhold 15%, 1/5 of the gross sale price, and they send that money directly to the IRS. It's a way for the government to make sure they get any capital gains tax the seller might owe.
15% of the gross price is a massive chunk of cash to have held back at closing. So how does the ITIN play into this?
The seller's ITIN is the key. It's the ID number needed to file all the required forms, Form 8288, 8288 to report the sale and the withholding. Without the ITIN, the whole process just grinds to a halt.
So can a seller avoid that huge 15% hit if they know their actual tax bill is going to be way less? If they only made a small profit?
They can reduce it, yes, but it takes serious planning. You have to be proactive. The seller has to apply for what's called a withholding certificate. That's Form 8288B. It proves to the buyer that a smaller amount is okay to withhold.
And I'm guessing, based on our sources, this isn't exactly a quick process.
Got it all. Far from it. This can take the IRS anywhere from 3 to 6 months to issue that certificate.
Wow.
So the seller has to get this started months before they even plan to close. If they don't, that full 15% will be withheld, and they'll have to wait until they file their taxes the next year to get any of it back. It ties up a huge amount of their capital.
That timing constraint is the real aha moment. Suddenly, the ITIN isn't just a number to get a mortgage. It's an active, strategic part of your financial future.
It forces you to plan ahead.
So to bring this all together for everyone listening, we've laid out this ITIN loan path. What are the key takeaways for anyone thinking about this?
I think the ITIN loan path is all about a necessary trade-off. It's flexibility for risk. You get huge flexibility on how you prove your income, bank statements, P&Ls, non-traditional credit. But you pay for that access. You pay with higher rates and bigger down payments, often starting at 15%.
But the benefit is so clear. These programs give a real structured path to homeownership for people who are financially stable but are just locked out of the system because of their ID status.
And this market is getting more competitive, which is good for borrowers. We see lenders offering nice perks, like supporting people with no credit history at all, or like FNBA getting rid of prepayment penalties. It ensures that the borrower's financial stability, not just their immigration status, is really the deciding factor.
So if you're an ITIN holder and you're thinking about buying a home, remember this. The ITIN isn't just about qualifying for the loan today. It's a foundational piece for any future real estate deals, especially for managing that VRP tax compliance when you eventually sell.
That's the long view, absolutely. For anyone pursuing U.S. real estate, having that ITIN properly documented is just a critical piece of financial planning that starts months, not days, before a big transaction. Understanding these things saves money and avoids major headaches down the road.
Planning ahead means stability. Thank you for guiding us through this very specialized but very crucial area of lending.
My pleasure. It was great to talk about.
That was the deep dive. We'll see you next time.